Hey there, you're listening to Paradigm Shift, a podcast about people building the future and pivotal moments in their journey. We're thrilled today to have Semil Shah on the show. Semil is the founder and GP at Haystack, an early-stage VC firm with 450 million AUM. He's an investor in 200 companies, including DoorDash, Instacart, Hashicorp, Figma, and many more. And you may know him from his writing. He's been sharing his observations on startups, founders, early stage markets for, I'd say more than a decade on Twitter, his blog, TechCrunch, The Economist, and more. We're super excited to have you on. Welcome.
Thank you guys for having me. Great to meet you. And yeah, really appreciate how organized you are about the show that we're going to do. So ready to follow your lead.
Amazing. So, and we try, so appreciate that. So I would love to start with Zain and I both follow you on Twitter, and you dropped some like really thought-provoking gems, and we wanted to start with one of them around the current fundraising environment. I don't know if I'm allowed to say this, but Zain's working on startups, so he's lived this in the last few months. He's done it very well, I have to say, very proud. But your tweet, it says basically you've been investing for 10 years, and in the next 2 to 4 months, you think this will be the absolute hardest stretch within that decade for early stage founders to raise capital. So just kind of curious, like, how did this thought come to you? What are kind of like some of the data points you're seeing behind this?
Yeah, I mean, it's just the look and feel of it, right? Like it feels like yesterday I wrote my first check out of Haystack. So it's been a little under 10 years. And I recall other moments in time where it was tough, but this feels like prolonged and different. And so I just sort of stepped back and it was like, yeah, this is in the 10 years. And I've only been in this market. I don't play across stage or anything. This is the toughest time. It doesn't mean it's a wrong thing to be the right thing. But the way I got to that was like the fact that like stringing a couple things together. So a lot of investors this summer, frankly, didn't do a lot of new deals because they wanted to reconnect with their kids or their family or travel from pent up COVID stuff. And when you stop investing, you start reflecting. And when you reflect, you're like, oh, that was a dumb decision, or that was a dumb decision, and you start remembering your bad decisions. And when you're an investor in private markets for equity, all of those decisions are irreversible decisions. They can compound both positively and negatively. Like if you followed into the same company 3 times and the company is bad, it's not just 3 bad decisions, they compound. So you have that. Then you have the fall is traditionally the busiest time of year. So if I were to plot out every September, Labor Day to Christmas for the last 10 years, it's always nuts. Kids are back in school, investors are back doing what they're doing. Everyone's trying to finish something out for the end of the year. So you have the summer reflection of like, oh, what did I do wrong? Let me ruminate on that. You have the natural sort of intensity in the fall. Then you have like the corrections that happen, right? Where there was like a summer rebound and then right before summer, interest rates went up again, pretty aggressively. And so the money supply, it just felt like was constricting. And then, basically I think people took a pause and were trying to figure out all sorts of things. Like the investors were thinking, how fast should I be investing my funds? Or what are the actual metrics I need to see per stage in order to have like a good investment return? So anyway, I could go on and on, but when you put all of this together for the full, it felt like the worst time for people maybe in Zain's position to try to raise capital. That being said, there were competitive, like tier 1, tier 2 firms chasing after deals that were, in the hundreds of millions for Series A's and B's and contest. I still feel like 2 people starting something with a prototype or an early business, if they're good, they can raise a couple $1 million. So there's plenty of money. I just think people are holding on to it longer. And it's probably a good thing because for 2 reasons. One, on the allocation side for us VCs, it's good to have a natural checkpoint between each financing because in the past, it's been more speculative. The next investor takes a speculative or look on it. Now it's tilted all the way to the other side, which is show me, don't tell me. And then on the LP side for the VCs, like they were taking a lot of money from LPs and then going back and asking for more. But really, as a manager of LP capital, you should be building some time diversity into your portfolio. So, you went from an era where people would have funds where they would allocate initial investment decisions over 3, 4, even 5-year period down to like 12 months, 18 months. And there are a number of problems that can occur, both qualitative and quantitative, when you deploy capital that fast. So anyway, I'll shut up now, but you throw all of that in a blender and you get the experience Zane gets.
To be fair, I think your tweet was spot on that it is a challenging market. I don't know if it's the most challenging. I think you would know that. But I saw it and I was like, okay, challenge accepted. This sounds great. We didn't get out unfortunately. Like, we have a product and good growth, and so it wasn't terrible. But I think there is like a greater sort of like burden of proof, like more rigor in the process, slightly slower decisions.
Yeah.
Sounds like you've been reflecting, and I think the whole sort of like ecosystem is in a bit of a reflective and get your bearings for what's next kind of state. What have been some of your reflections? Like, what are some things you've observed have been characteristic of your best decisions and maybe also your worst decisions over the last few years?
I think that you're exactly right. A lot of investors have been reflective, and many are just reflective by nature, right? So it's like extra reflection. So I think like I think about the question you asked all the time, and in the bad decision camp, and again, this is about stuff you can control, right? I feel like definitely we made some poor decisions, or let's say mistakes. I use this sort of framework. There are 2 types of mistakes: recoverable and irrecoverable. And I think the good news for Haystack is we did not make any irrecoverable mistakes. There are mistakes of what I call like omission and commission. So omission are things you passed on that turned into great things, where you didn't make the call. And then there are mistakes of commission where you wanted to do it, but it turned out to be a bad decision. And so there are plenty of those to like review and think about. And I think a lot of it comes down to, honestly, like quality of founding team. And it kind of makes sense too, because the last few years, like, we haven't spent as much time in person. I don't know how that's going to snap back and when. It feels like investors are looking more for that now. And then in terms of like, good decisions, I feel like we made unintentionally a lot of good decisions over 10 years, primarily keeping the fund size small and staying disciplined around our portfolio construction. So like, you guys as entrepreneurs or would-be entrepreneurs who go out and you think, oh, well, how do I raise the amount of money I need? And, you don't really think about how do I create an incentive for the investor? What does the investor need? That's not really the entrepreneur's problem. And I think a lot of people, there was so much money in the market, so the investors would raise bigger and bigger funds and they would earn more fees. And there's some perverse incentive to that, but then you would start deploying more. So if Zane comes and knocks on your door and he's raising $2 million, you might offer him $4 million to get more ownership. And so it's a slippery slope. And so I think, while we definitely made mistakes of commission and omission, at the end of the day, they're totally recoverable because we build a portfolio that's very well thought out. And we really didn't raise our funds too big. We didn't invest them too fast. The portfolio entry and the deal geometry looks very uniform. And, that's not an accident.
So you mentioned some of the biggest mistakes in your reflection have been maybe like not understanding or evaluating the founding team correctly. How do you do that? Like, what is a great founding team? Because there's so many flavors of this, right? There's like the young YC founder. There's like, Apurva, who was like, like proven founder, working through a bunch of ideas, eventually hit on like Instacart. There's like super proven people who understand the problem space. So it's a challenging question. And so what brings clarity to that question in your mind? How do you approach what makes a great founding?
Yeah, clarity is a strong word. What sort of defogs your windshield, but it's still foggy? I would say I would sort of start at 30,000 feet and then get to ground level. So as an investor, and I try to explain this to entrepreneurs a lot, and most of the time I'm not successful because either they don't get it or they don't care, which I don't blame them. Um, our job is to make investment decisions that go into a basket of risks. So there's a certain number of checks or entities or names in the portfolio that go into the basket. And I think the first thing is like, hey, you've got to catch some big outcomes in that basket in order to have a chance for the fund to work. So there's some number you need to put in. Is it 15? Is it 75? There's some optimization you need to do based on what you think your deal flow is like, what kind of ownership you can get, how big your fund size is. It's sort of multivariate problem. So you set up on a range of a number. I would say that's number one. Number two, you have to think about like, how do I create the most amount of time and flow of people so that I meet lots of people? So you have to meet lots and lots of people in order for somebody to stick out. It's not like I could take 3 pitches a week for a month and then just say, okay, out of these 12 pitches, like this one was the most interesting. I actually need to meet like 20, 25 people a week, or at least communicate with them to get a sense of like who actually really is differentiated, who's spiky. And it's hard to do that. So if I'm meeting 12 versus 80 people, I feel like there's some number in there. Maybe it's not 80, but it's not 12, where you're meeting that amount where you say, oh, this person or this group or this product that actually just feels and looks different than all the rest. Okay. So that would be the second piece. Related to this piece is, how do you go meet those people? Like you can meet 80 losers, right? There's lots of people with the startup who, if I ask for a meeting, and I don't mean that pejoratively, it means like, hey, you're not like, we're not going to do business, but like I can go get meetings, but those meetings have to be like pre-qualified in some way, right? So the network or something you're doing has to bring you the set of people to choose from. I always describe it as like, there's 100 leads a month we get, if you think of it in like a sales context. And taking the 100 down to 30 is actually pretty easy. You just do it over email or ignore. Then of the 30, how do you get to 3? Well, take some emails, some initial calls. And then the tough job is like every month you meet 2 or 3 people where you're like, oh, they're great. And actually you don't have control whether they invite you to the round. The deal geometry may be off. You may decide to do both. You may lose both and you just don't know. So it gets into the third thing, which is you have to have some ability to connect and get on the wavelength with different entrepreneurs very quickly and make them feel comfortable. You know, that like you're interested in what they're doing. And then you have a conversation. Then we talk about like what happens in the conversation. And we tend to be very conversational investors. So like if Zane, if you were pitching us, we ask for like 3 hours of conversation in different formats and some time in between, because we usually feel like we can get the picture of a person over that time. So it requires an ability to like converse, show interest, show that like the interest is natural, to be referenced against other people. And then it's like the geometry piece where I may say, well, Zane, I want to own 20% of your company. And you're like, hey, I'm only doing 20% dilution in this round. And 5% is going to angels, coworkers, friends. And so already I'm cut to 15. But you may say, well, then there's this other pre-seed fund that wants to put in 500. They've been with me in my last company. So now I'm down to 10%. Right. And so there's many ways this can go off the rails. And one of the reasons we keep the fund small, to protect against that. But anyway, that's sort of a high level of 30,000 foot at the beginning of the month to get to the end of the month and say, okay, I want to work with this person.
Yeah, that's really helpful. And it's interesting to hear that perspective, because I think everyone has a slightly different approach. We had Keith Raboy on, and he talks about, okay, what are the key risks? And is this team or person like best suited to tackle those key risks? And
that's all part of it, right? I'm just talking about it at a really high level. Like the conversation goes into the stuff Keith is talking about. Yes.
Yeah, 100%. And some of it also, I think, from what you were saying, gets into like a deployment schedule, right? So like, I mean, most funds have some kind of like time frame in which they want to like invest the capital they raised, and so that means taking a certain amount of meetings, having kind of almost sales pipeline every month, like you mentioned. So we're going through a phase where there's a bunch of money that's been raised. There's been a slowdown in investment. Like, how do you think about what that means for some of these big-ish funds over the next year or two? Like, what do you think that deployment schedule looks like, and what does that mean for the ecosystem in a sense?
Yeah, I think David Saxon All In, maybe like a month or two ago, gave the best synopsis of this. A lot of these bigger firms would start to deploy their funds in 12 to 18 months. But now they know they can't really go back right away to their LP base on the same schedule. So they're going to push their next fundraise. They're going to tell their team, hey, we would have raised in 18 months. Let's make that, longer, 30 months, 36 months. And so just by that, the pace will naturally slow down. So there's many governors on this that will slow down the pace. So number one is like the leaders of these firms saying our next fundraise is pushed on. So it slows things down. Then, the people running these firms who are watching reserves and the budgets, and they're slowing down deals or like killing deals. Then you have the actual like trips on the ground who are bringing deals back to the firm, and they're not bringing as many deals because they don't want to be rejected. So it sort of has this like compounding effect of slowing down. And then you have social media, which I think was very fast to disseminate all this information to founders, although it's questionable whether they accepted it all at the same time. Like the dissemination of this stuff throughout VCs and LPs, right? So people correct their behavior almost in the other direction very quickly.
When you said that you meet with founders like multiple times and you're kind of getting a read on them over the course of some period of time, that makes a lot of sense because the stage you're investing in, it's very early, right? So the quality of the founder, hugely important. Obviously, there are many other factors to consider. When you get to that stage with a founder, what are the criteria that you're looking for to make your decision to invest? And like specifically, there have been a few cases where, you've seen talent like really early on, right? With like Tony at DoorDash or Apurva at Instacart. So in situations like that, like tough market, but obviously very promising founder, what in your brain was going on that was like, oh, this person is exceptional, and what kind of pushed you over the edge to make the deal?
Again, we get this wrong a lot, but we only have to get it right a few times. And also in the case where we can get it right in terms of founder quality, their market or execution, it's not a perfect thing. And again, I go back to this basket, right? Which is, can this person in the basket have the potential to return the whole basket?
Well, take us through some examples, any that come to mind. Like, here's a company founder, here's sort of how I thought about it. And if you think of one.
The one that comes screaming out at me is this woman named Adit Levine. She lives in Boston. She's the founder of Solo.io. She's in the open source space. And so basically, another co-investor friend of mine said, hey, we're investing in this woman. She's lights out, amazing. It turns out that someone else who committed to her round, like, has something going on with their fund, and she's here for a few days. You want to meet her? I was like, okay, yeah, sure. So I immediately hop on it. And we had done some open source investing before, and we had just had like twin boys. So we had 3 kids. My household is exploding. And I had this previous stuff, and she's in town from Boston. So I said, hey, Adit, our mutual friend introduced us. I would definitely want to meet you. Unfortunately, these are the only times I can meet you. And I know you're leaving on whatever Sunday or something. Or, and worse, you can come to my house Sunday, but I cannot leave my house on Sunday. So she comes to my house for like 2.5 hours. She's basically interviewing me. She's playing with my daughter. And then at the end, she's like, you will invest in my company. I was like, okay. Never had that before. But she was like really in command. And, she really took the introduction seriously. So, I had no clue, but that was just different. Yeah. I don't know. But the way I was going to answer your question without an example would be to say, like, look, some of the assessment is intellectual. Like, okay, Zane, like, what have you learned? What's the insight? How did it come to you? Like, why are you so obsessed about it? Like, have you thought about X, Y, or Z risks or edge case and like testing how much work you've done on your own on it? Part of it is like evidence based or like historically based. Like we would ask you questions about your background because our belief is like very few people will express a new gene moving forward. Like, at whatever age you are today, like it's likely if you have a commercial gene, you've expressed that, or it's likely if you've had an entrepreneurial gene, you've expressed that, or whatever, you know. And then the third one is sort of behavioral, which is like what in this person's background and behavior, could lead to like an outlier outcome or success. So like the fact that Adit came to my house, like ran the show, played with my kid, asked my wife some questions, was asking me about what I like to do and like how I work with entrepreneurs, and then just told me at the end I'm investing. I'd never seen that before. So, again, that's the behavior of like, okay, she's got a plan and there's stuff together, and, I'm invited along.
Are there certain things that like when you see a founder doing, they just make you like want to invest immediately?
Maybe it's traction. I don't know.
Yeah, that's the obvious one, right? It's
No,
like 100% week over week growth.
No, because when we invest, there's no real traction. It's very rare. I would say like it is rare, but I would say like either a really interesting demo, or an articulation of a vision that's really specific and unique. But both of those are pretty rare.
Yeah, in my experience, I've never done a demo and had it not help. Like I think as a founder, if you have a demo working product, I think it's probably helpful.
Some investors hate demos. I think it just depends. Like,
yeah, totally. I'd say in 90% of calls I haven't done one, but occasionally it's helped. Now, I want to get a bit of a sense of, so you've got this large fund, not too large, but sizable. And, you've been deploying over the last few years, I'm sure, at high valuations. And we've seen sort of this like, valuation compression in the public markets. How do you think about that as an early stage investor?
Well, so number one, we didn't do a lot of really super high price deals. There were some high price follow-ons for sure, but I would say we were pretty disciplined. That's a big thing for me because I always feel like that's something we can control, right? And we have some latitude on certain things to stretch a little bit, So we kind of say like right now to close this year, we're doing investment in one kid who's got an amazing demo and prototype. It'll be $5 million on 25 posts. It's not a normal deal. But I viewed it as like, hey, this is a Series A. This is his seed and Series A together, and it's either going to work or not work. And so we do a couple of those per year, but I would say we're pretty disciplined on that. Now, how do I think about it in terms of public valuations? I think a lot of the technology stocks that are in the market, meaning like there's real technology behind it, are undervalued because all the computers that are trading everything don't discern between, they're just discerning between technicals and company metrics and fundamentals, which are important. That being said, I have told a lot of our co-investors and LPs and also founders we work with that, the next Zane who starts their company, their seed, Series A and their Series B round, if they progress well, may all be under $100 million post money. That's a logarithmic scale down from what it used to be of like 10, 100, and a billion. There's something in the middle there. So it's just it's been super compressed. And I generally think that's a good thing,
Yeah. What are your thoughts on that? So I think on one end of the spectrum is like raise a lot, probably like burn a lot and has slightly worse economics, right? You could argue that was the Instacart strategy, the DoorDash strategy, poor economics for a while, or maybe like, on the fence economics, but it's a marketplace. You got to like, build liquidity and sort of grow fast for like some of those network effects to kick in. But they operated at with tough economics for a long time, right? And then there's today when maybe like you have not as much money, companies are going to be forced to have stronger economics on day one. And I think there's a lot of benefits to that. There's also some negative trade-offs and like the rate of growth. So how do you kind of think about that? I mean, part of it is this, that you got to just work with the market you're in. But in your mind, what do you think is the right spot? Like, should companies try to be profitable early on? Should they? I don't know. What's a framework that maybe a founder can apply to think about? Okay, like how much should I focus on default to live and profitability versus like growth?
I think number one is like, are people actually using it and want the thing? Forget about the money. Are people like using it? Do they want it? Do they want more? Are they asking for things? Or is it tough for you to keep up with demand? Because right now, I think in this kind of reset, everybody is hunting for like, what is a true signal of demand? Because demand has been distorted. So it's an entrepreneur's job to like go look for the vein to tap and then boom, tap into the vein. And that's hard. So I think number one is like that. Then it's a question of like quality and magnitude. So like, okay, people like this stuff. People want more of it. They demand it. Is it like a bunch of fragmented mom and pop shops that want it, or is it Stripe that wants it? And so there's a spectrum. And so people will be judged on the quality of initial customers or users or pilots because they're seen as like leading indicators for something. And so you want to be closer to Stripe as a tech entrepreneur than the mom and pop shops. Although there is a way like to show like assembling SMBs like you would assemble a consumer as a customer. So then you get into your quality of company, and then you get into like willingness to pay. And so I think showing willingness to pay at a higher dollar amount, like if you can show 6-figure in the enterprise ECVs, even if you're not profitable to begin with, is extremely valuable. And then typically the way venture capital works, and now in a low interest rate, higher interest rate environment, is like the beauty of these business models is like you invest a little bit, but then you can crank out money later if you're doing it efficiently. The problem is that these things have been overfunded to date, pushing up the valuations that just don't really make sense. So I think those are the things that really matter. And then I think for an early stage investor like Zaid, if you've had those kind of characteristics, if you can tell the next investor, hey, these are the customers that want it. 70% of them are what we would consider top tech companies or, Silicon Valley companies or whatever. And that, they've told us there's a plan to go from our 5-figure pilot to 6-figure contract. And, that's a lot more than how the Series A's are getting done. And so to me, profitability is less important then versus having those conditions met and having a founder or founding team who has that commercial gene to say like, hey, trust us, like at the right point, we're going to turn that on. Because in the past, it's been like, well, we'll just deal with it later, and hey, investors don't bother us. And hey, we want operators on our board and not investors. And,
Yeah, that makes total sense. And some of those examples were super helpful from a B2B lens. How do you think about consumer? Like some of your best investments, it seems, have been consumer. And down markets tend to be great for consumer, from what I've seen. So how do you think about that segment?
I think I'll probably talk out of both sides of my mouth during the segment because it's confusing. It seems like if you go back over the last 15 years and you look at like a Bureau of Labor Statistics chart on like where households spend money, like the last 15 years have been like scaled venture-backed startups and public companies that go eat into the wallet share of a consumer. The places where it's been really difficult are like more regulated industries. So like energy, health, people are seeing their costs skyrocket. And so I would say, even though it's easier to point out what's not working, there will always be consumer trends and companies that people wrap around. Maybe it's why Aurora Solar took off is because, pre the Ukraine war, right, people were looking for ways to reduce their energy bills. So there's probably tons of other examples of this. I just don't know what'll be that big because the other ones were sort of in unregulated industries that didn't really require permission. So you're able to do Instacart, DoorDash, Airbnb, everything. So I just wonder sometimes like how much of the consumer wallet did we just completely harvest, and left almost nothing left.
Semil, we touched on something, I'm switching gears a little, but we touched on something earlier, which was kind of the state of affairs of the fundraising environment and, the broader market. And you had this tweet, which I thought was really interesting, which was around the Microsoft Activision acquisition, how it got blocked by regulators, and has kind of created this weird dynamic in the market where M&A might not be happening at the smaller ends because of the market pullback. It might not be happening at the larger end because of antitrust. And so to go public, you need a solid business, hundreds of millions in revenue. I'm just curious to hear your take on how long you think this will last and what does it look like? When would we might expect the norms in the public markets to change?
Well, I have no idea.
I think, Ashish, what you're trying to get to is what does liquidity look like, right? At the end of the day,
oh yeah, liquidity. Yeah, sure. So I can explain, I don't know if it's obvious, but I can explain a little bit about that tweet. But to your question about the public market, I have no idea. But when we go back to the basket and we put the 30, 35 names in the basket, all the money, we take liquid money and turn it into illiquid position. And so in a previous era, for example, there's a company called Tube Mogul, Tube, like a television tube. I think they raised 25 million bucks, maybe a little bit more. And they went public and were considered a small cap IPO. And I think the company ended up being acquired when it was public, but it was 400 million, 500 million of market cap, wasn't the front page of TechCrunch or anything. But it's no small feat. And, the entrepreneurs, one of them is sort of friendly with us. Great people. It's just hard to see the bankers today wanting to do the business of that and float that. Maybe they should. I don't know how that business works. So I think that the first point I make is that the bar to actually getting a meeting with Morgan Stanley or Goldman Sachs and going public is hundreds of millions of dollars where they start to get excited. So if you don't have a company that reaches that in a tech forward, fast way, what are you left with? The only other way to invest, let go of or cash out your investment is to sell it to another investor, which is not super easy, or to have a company be acquired, which again, it's one of these things that looks easy and fun on TechCrunch. But in reality, it was extremely painful and hard. And so I wrote that tweet to basically call out that if Microsoft feels like it's a nuisance to deal with the Fed, to deal with this acquisition, it may impede their desire to do more because they don't want to ruffle more feathers or cause more process for themselves. And so once companies start saying well, hey, I don't want to acquire that, then you have a whole other channel for exits and liquidities for VCs closing. And so what the needle you have to thread to get to 100 million of revenue is ridiculous, is a lot. And so one could argue that you should only invest post revenue so that you at least have a chance, to go okay, it's really hard to go from 0 revenue to 1 million revenue. Is it that much harder to go to 1 to 100? Right? Once you made it that far, I don't know the math, but that's sort of the calculus.
But at 100, you think there's a market for liquidity where we see funds can return.
Again, I think if they're considered a good tech forward company, yeah. There's famous posts by Bill Gurley, not all revenue is created equal.
That makes sense. So switching gears, you're investing actively. You've maintained your fund size. You've been disciplined. So curious to hear, like, what are you excited about? Like, what spaces are you excited about? Are there any like ideas or problem spaces that you're excited about?
I don't think that way. I literally feel like, I wake up every day. I try to meet 2 or 4 interesting founders every day with no preconceived notion. I may have a view of their market or where the trends are going once we chat. But I try to wake up every day as like a new day. It's almost like a groundhog day. And that's deeply rooted in the philosophy that if I were the type of investor that had a vision for all this stuff, I would either only be focused on that vision or I'd be building it myself. But I think as investors, we can only react to what we see. We can't create it or envision it.
Makes sense.
Awesome. One last question, and then I think we can go to closeout. So as you think about the next 18 months, you've gone through this reflective phase the last few months. What is your investment strategy for the next 12 to 18 months? And in general, what is your advice for like people starting and building companies in this environment?
My plan for us is we raise our funds every Q2 of an odd year. So we'll have a little fundraise there. We'll probably raise the size of the fund a modest amount. Keep doing the same thing. I think we need to push ourselves on the deal geometry I was talking about before. So slightly larger checks for certain companies, slightly more ownership, keep pushing that up. And then, just be mentally available to be swept off your feet by the next great founder, right? So part of it is just staying open to that, which is too busy, It's counterintuitive. I feel like you can do a lot of busy work and then you're stuck in the busy work and then you miss the main thing. And then for entrepreneurs out there, I would say it's really a test for entrepreneurs to go through a variety of intellectual thought exercises. So in no particular order, like Zane, for your company, I would challenge you. Can you spend a day or a weekend with your colleagues or just yourself and write out a feature in which you never raise venture capital again? What would that look like? What would you do?
I think he literally does that, actually. Or did that at some point.
I'll show you if you want.
Yeah, let's say in goal setting, you can say, hey, look, I really think in sprints and I want to start the year on January 1st and put our head down in this new sprint and look up, at Memorial Day. What do I want to get accomplished by then? And why are each of those accomplishments potentially important and value driving for the company? Again, this can all fit on an index card, right? It's not like you have to write a treatise. So I would be like advocating for that for early stage founders. But I guess depending on where you're on the ecosystem, I would have different guidance. But that at least for founders seems like good hygiene. And then, if you do want to raise capital, the burden of proof to share why you're a good investment has gone up tremendously. And I can tell you on the other side, like the investors, like they hear a lot of pitches and they're not going to try to tease it out of you unless they're really interested. You have to tell them. Right? And so maybe being a little more forward and saying, hey, like we started this now. Here are the things that we're not happy about. Here's where we think it can go and why it's important. And, it's going to require a lot more finesse and a lot more salesmanship from founders.
I think it's great advice. So, Semil, we have a couple of questions that we ask everyone at the end of the show. It's a few quick ones. The first one is around feedback. What's the most challenging or difficult feedback you've received, and how have you processed it and incorporated it moving forward?
You said difficult or painful?
Challenging or difficult, but painful. It's very closely related to paid, I think.
I think it's people encouraging Haystack and me by proxy to like write bigger checks and take more of a leadership position in early rounds. And we have been doing that more and more, but it's painful because or challenging because it's a different style of engagement. Can be more adversarial in some ways with the founding teams. Not to say there's conflict, it's different than just slotting in a check and going. And that, there's pressure to like increase your fund size with the chip size going up. I've always just been sort of like a disciple of like what the math says. And so I'm trying to keep things really small. So that's probably been the most challenging feedback I've gotten for years of like people wanting me to do more, raise more, invest more, be more assertive. And I've always felt like the founders we want to work with wouldn't tolerate that. So, it's like, yeah, I could do it, but am I working with the people I want to work with? I don't know.
Yeah, totally. So the second question is around superpowers. Everyone has a set of skills that feels like play to them, but work to others. What are some superpowers that you found in yourself that you like to lean on day to day?
Yeah, I don't know how this happened, but I think I'm able to like use language in a succinct way that people pay attention to it. I really don't know why. I don't know. Like, I think people sit around and think like, oh, he crafts the tweets or he's really thinking about it. They just like come to my head and I spit it out. I would actually credit Twitter as a medium for like continuing to hone that. But I'd probably say that's a superpower, right? Of like succinct, impactful communication.
That sounds right. Last questions around reading. What are you reading these days that has stuck with you that you would recommend to others? Could be anything, professional or personal.
Yeah, I struggle with this question because I don't know if either of you have kids, but
I have an 18-month-old. Yeah.
Maybe this is a preview for you. My book, my reading of books dropped precipitously once I became a dad. And so I just never had the time. But I listen to lots of podcasts and I have the YouTube premium. So I listen to a lot of interviews as if they were podcasts or books, right? So that's sort of my reading. A couple of things that stand out. I would say, and I'm going to write something about this earlier. I don't know if you know who Ken Griffin is. He's a founder of Citadel. He is considered to have some of the best data in the world as a market maker in hedge fund. I found like his insights this year were like really impactful and prescient. Like he saw a lot of things and how they were connected to either policy or economics or consumer behavior or workplace behavior. Like he's been sounding the alarm for months of like this productivity gap that like remote work has engendered. And then I would say I listened to like a lot of long tail interest stuff. So like recently I've been listening to like these different clips either on Joe Rogan or Lex Friedman or any of these people who interview people who are doing clandestine services or in the CIA, just to zone out on like how they do their work. And then I listen to a ton of music. So I feel like at the end of the day, if someone gave me a book or like an album to listen to, I would choose the album every day. So music's on all the time.
Makes sense. Well, Semil, this has been such a great conversation. We've enjoyed it a lot. It's so great to talk about a wide range of topics with you. Thanks for coming on. We really appreciate it.
Yeah, and I hope it was useful for your audience. I guess we didn't get into what happens when you're at a public company with underwater options, but I guess that's for another time.
I think you go cry in the corner and just wait.
Yeah. Yeah. Well, anyway, thank you guys so much.